The cryptocurrency market has entered one of its most anxious phases in recent memory. According to the widely followed Crypto Fear and Greed Index, sentiment has collapsed to 14 A-level, categorized as extreme fear. For context, this index aggregates market volatility, momentum, trading volume, social sentiment, and Bitcoin dominance to gauge investor psychology. Readings below 20 are rare, and historically they tend to appear only when fear overwhelms rational decision-making. This is no longer just a routine pullback. What we are witnessing is a psychological breakdown across the market. When the index drops this low, it signals that market participants are not simply cautious, they are afraid of further losses. Investors are prioritizing capital preservation over opportunity. Risk appetite vanishes. Every price drop feels like the start of something worse. In practical terms, this fear shows up in very specific behaviors. Retail investors rush to sell at market price, not because fundamentals have changed overnight, but because uncertainty has become unbearable. Long-term narratives, Bitcoin as digital gold, crypto as a hedge, blockchain adoption, are temporarily pushed aside by one dominant emotion. What if this keeps falling? We've seen this pattern before. In March 2020, during the COVID liquidity shock, the Fear and Greed Index plunged into extreme fear territory as Bitcoin collapsed alongside traditional markets. In late 2018, during the post-ICO crash, similar readings appeared as confidence evaporated. Each time, the market was not reacting to a single headline, but to a loss of collective conviction. That same dynamic is unfolding now. Importantly, extreme fear does not automatically mean the market has reached the bottom. What it does mean is that price action is no longer being driven by optimism or growth expectations, but by emotional risk aversion. At this stage, even neutral news can trigger sharp sell-offs because investors are already positioned defensively. For U.S. viewers, this moment should feel familiar. It mirrors the psychology seen during equity market panics when the VIX spikes, liquidity dries up, and investors rush into cash or treasuries. Crypto, despite its unique structure, is not immune to these behavioral cycles. The key takeaway here is simple but critical. This is not just a market correction, it is a confidence event. And when confidence breaks, the next question is no longer how high can prices go, but where is the pain threshold? That question leads us directly into the next part of the story. Because as fear intensified, Bitcoin began losing key psychological levels, setting off a chain reaction across the entire crypto market. As fear tightened its grip on the market, Bitcoin, the asset that anchors the entire crypto ecosystem, began to crack at the levels that matter most psychologically. In financial markets, psychological price levels are not defined by technical complexity. They are simple round numbers that investors remember, watch, and emotionally attach to. In Bitcoin's case, zones like $70,000, $65,000, $60,000, $000, or $55,000 are not just prices, they are confidence markers. When those levels hold, investors feel reassured. When they fail, sentiment can unravel quickly. That is exactly what happened. Bitcoin did not drift gently below these thresholds. It broke them decisively, triggering automatic sell orders, stop losses, and margin calls. For many traders, these levels were lines in the sand. Once crossed, selling became mechanical rather than thoughtful. This is how a psychological breakdown turns into a market event. In traditional markets, the same phenomenon appears when the S&P 500 breaks a widely watched moving average or when the Dow drops below a major round number. The logic is not always rational, but the reaction is very real. In crypto, where trading is global, leveraged, and continuous, the effect is magnified. Consider a common scenario. A retail investor enters Bitcoin near a recent high, reassured by headlines, ETFs, and institutional adoption. Their risk tolerance is built around the idea that Bitcoin won't lose this level. When that assumption fails, fear replaces strategy. The result is forced selling, not because the investor believes Bitcoin is worthless, but because uncertainty feels more dangerous than loss. This breach of psychological support also sends a powerful signal to the broader market. Bitcoin dominance may rise temporarily, but confidence across altcoins collapses. Market participants begin to assume that if Bitcoin cannot hold, nothing else will. Importantly, these breakdowns create self-reinforcing momentum. Each failed level invites new short positions. Each bounce that fails to reclaim prior support confirms bearish expectations. What once felt like a temporary dip begins to look like a trend. For U.S. investors, this moment echoes past episodes in risk assets when NASDAQ stocks lost key levels in 2008, 2018, or 2022. The fundamentals did not disappear overnight, but price action reshaped psychology far faster than analysis could keep up. Bitcoin breaking its psychological floors does not by itself define the end of a cycle, but it does change the rules of engagement. The market stops asking, where is the upside, and starts asking, how deep can this go? And once those questions take hold, the pressure does not stay contained within spot markets. It spreads especially into leveraged positions where the next wave of selling is not voluntary but forced. As Bitcoin slipped below key psychological levels, the damage did not stop there. It spread outward rapidly and unevenly into the altcoin market, where losses became significantly deeper. This is a classic risk-off rotation, and it appears in every major market downturn. In times of stress, investors do not treat all assets equally. Capital flows away from what is perceived as speculative and illiquid and toward what is considered relatively safer. In the crypto ecosystem, Bitcoin sits at the top of that hierarchy. Altcoins, particularly smaller cap tokens, sit at the bottom. The result is predictable but brutal. While Bitcoin declined in measured steps, many altcoins fell 2 to 3 times as fast, erasing weeks or even months of gains in a matter of days. Projects with strong narratives, active communities, and solid development roadmaps were sold alongside purely speculative tokens. In a risk-off environment, nuance disappears. This behavior mirrors what U.S. investors see in traditional markets. During equity sell-offs, money exits high-growth tech stocks and moves into large-cap defensives or cash. Crypto follows the same psychological playbook, just at a much faster pace. What makes altcoins especially vulnerable is liquidity. Many altcoin markets are thin compared to Bitcoin. When selling pressure increases, there are fewer buyers willing to step in. Even moderate sell orders can push prices sharply lower, amplifying volatility. There is also a second layer of pressure portfolio triage. When investors face losses, they rarely sell everything equally. Instead, they cut positions they believe they can live without. Altcoins, often viewed as optional or experimental holdings, become the first assets to be liquidated. This accelerates downside moves and reinforces the perception that altcoins are dangerous in unstable markets. For retail investors, the psychological impact is severe. Watching altcoins drop 20, 30, or even 40% in short time frames creates a sense that the market is spiraling out of control, even if Bitcoin itself remains relatively stable by comparison. This is why altcoin crashes often feel more dramatic than Bitcoin drawdowns. They do not just reflect market weakness, they broadcast panic. From a structural standpoint, this dynamic also reveals where capital is hiding. As altcoins bleed, funds move into Bitcoin, stablecoins, or leave the crypto market altogether. It is a defensive posture, not a conviction trade. But this phase carries an important implication. When altcoins collapse faster than Bitcoin, it signals that investors are no longer positioning for upside, they are positioning for survival. And once that mindset takes hold, the next force to shape the market is not choice, but mechanics. Because beneath this risk-off shift lies another accelerant leverage. And as leverage positions begin to unwind, selling pressure stops being emotional and becomes automatic. As prices fell and volatility surged, another force quietly took control of the market leverage. Crypto is one of the most heavily leveraged financial arenas in the world. Across major exchanges, traders routinely use 5x, 10x, even 50x leverage, sometimes higher, to amplify returns. In rising markets, leverage feels efficient. In falling markets, it becomes destructive. This downturn exposed that vulnerability with speed. As Bitcoin slipped through key levels and altcoins accelerated downward, leverage long positions began to fail. When collateral values drop below maintenance requirements, exchanges do not ask traders for patience or perspective. Positions are liquidated automatically. Assets are sold at market price instantly, regardless of conditions. This is not discretionary selling, it is mechanical. Each liquidation adds fresh sell pressure, pushing prices lower. That price decline then triggers the next layer of margin calls. The process feeds on itself, creating a cascade that can overwhelm natural buyers in minutes. For U.S. viewers familiar with traditional markets, this dynamic is similar to margin calls during stock market crashes, but on fast forward. Crypto trades 24/7 globally with no circuit breakers. When liquidation thresholds are breached, there is no pause for reassessment. Real-time liquidation data during this downturn showed hundreds of millions of dollars in long positions wiped out in short intervals. Many of those trades were not reckless bets. They were routine leverage positions placed during a period of apparent stability. But leverage reduces margin for error. When volatility returns, that margin disappears instantly. This is why market declines during leveraged environments feel sudden and violent. Prices do not fall because investors calmly decide to exit. They fall because systems force exits all at once. The impact extends beyond traders using leverage directly. Spot market investors, those holding assets outright, feel the consequences as prices plunge faster than fundamentals can justify. Confidence erodes, further reinforcing the fear already present in the market. Importantly, leverage-driven sell-offs often distort price discovery. Assets can overshoot to the downside not because demand has vanished, but because selling pressure is temporarily artificial. Once liquidation, slow volatility often subsides, but only after damage has been done. This phase marks a critical transition. Up to this point, selling has been fueled by fear and positioning. Now the market is being shaped by structure, by the rules embedded in trading systems themselves. And when structure takes over, the narrative shifts again. Because after the forced selling ends, the market is left asking a different question, not who was liquidated, but who is still willing to step in. One of the most striking aspects of this crypto sell-off is what did not cause it. There was no major exchange collapse, no sudden regulatory ban, no catastrophic hack or systemic failure. Instead, the downturn unfolded under the weight of multiple overlapping pressures, none of which were individually decisive, but together they proved powerful enough to break market confidence. This is often the most dangerous type of market decline. In financial markets, investors are trained to react to clear catalysts, an interest rate shock, an earnings miss, a policy announcement. When those events occur, risk can be measured, scenarios can be modeled, and positions can be adjusted. But when a sell-off emerges without a single identifiable trigger, uncertainty expands. That is exactly what we are seeing now. The crypto market is being squeezed from several directions at once. Volatility has increased just as momentum faded. After months of strong performance, upside narratives began to stall. Buyers became hesitant. Sellers, sensing weakness, grew more aggressive. At the same time, broader macro uncertainty continues to linger in the background, reinforcing caution across all risk assets. For U.S. investors, this environment should feel familiar. It resembles periods in equity markets when indexes drift lower, not because of one shock, but because confidence quietly erodes. The absence of good news becomes as influential as the presence of bad news. In crypto, this effect is magnified by the market's reflexive nature. Price weakness reduces enthusiasm. Reduced enthusiasm lowers liquidity. Lower liquidity increases volatility. And higher volatility discourages new buyers. Each factor feeds the next. This is not panic driven by headlines. It is fatigue driven by uncertainty. Market participants begin to ask broader questions. Has the easy money already been made? Are institutions done accumulating for now? What catalysts could realistically push prices higher in the near term? When those questions go unanswered, capital waits on the sidelines. Another critical element is expectation mismatch. Many investors entered the market anticipating rapid continuation of upside momentum. When that momentum stalled rather than reversed cleanly, frustration replaced optimism. Selling followed not out of fear alone, but out of disappointment. This is why markets often fall hardest when sentiment shifts from excitement to indifference. Excitement can be reignited. Indifference drains liquidity. The absence of a single villain also complicates recovery. Without a clear cause, there is no clear fix. Confidence does not return overnight. It rebuilds slowly through stability rather than headlines. And this brings us to the next phase of the story. As uncertainty deepened and momentum faded, attention turned to those who typically provide stability during turbulent periods, large holders and institutional participants. Their behavior or lack of it would become the market's next signal. As selling pressure intensified and volatility increased, one absence became increasingly noticeable: institutional participation. During periods of stress, large players, hedge funds, asset managers, proprietary trading desks often act as a stabilizing force. They do not rush in emotionally, but they do provide liquidity when prices reach levels they consider attractive. This time, that support has been limited. The market is not seeing aggressive institutional dip buying. Instead, capital appears to be on pause. This does not mean institutions have turned against crypto. Rather, it suggests a strategic decision to wait. In uncertain environments, large investors prioritize clarity over speed. They are willing to miss the first leg of a rebound if it means avoiding deeper downside risk. For U.S. viewers, this behavior mirrors what often happens in equity and bond markets during transitional phases. When macro signals are mixed and volatility is elevated, institutions reduce exposure, raise cash, and wait for confirmation before re-entering. Crypto, increasingly correlated with broader risk assets, is experiencing the same discipline. There are practical reasons for this restraint.
Institutional capital is constrained by mandates, risk committees, and liquidity requirements. Sharp intraday swings, frequent liquidations, and thin order books make entry expensive and unpredictable.
For a fund managing billions, timing matters less than stability. The data reflects this hesitation. Trading volumes during recent sell-offs have spiked on the downside, but failed to show sustained accumulation afterward. Price bounces appear shallow and short-lived, suggesting that rallies are being driven more by short covering than by fresh long-term buying. This creates a vacuum. Without large buyers stepping in, the market is left to retail traders, short-term speculators, and automated systems. In that environment, price discovery becomes fragile. Small shifts in sentiment can move markets, disproportionately reinforcing volatility rather than calming it. There is also a signaling effect at play. When institutional players stay on the sidelines, it sends a message, intentional or not, that patience is warranted. Retail investors interpret that caution as confirmation that risk remains elevated. Selling slows, but buying does not accelerate. The market drifts heavy and uncertain. Importantly, institutional hesitation does not mark the end of a cycle. Historically, it often appears midway through periods of adjustment, not at their conclusion. Institutions tend to return once forced selling has largely exhausted itself and volatility begins to compress. Until then, the market remains exposed. Without a reliable backstop, confidence struggles to rebuild. Prices may stabilize temporarily, but conviction stays weak. And when conviction is absent, the market's focus shifts again, not to buyers, but to survival, which leads directly into the next phase of this downturn, a broader cleansing process where weaker hands are pushed out and only the most patient participants remain. With institutional capital largely on the sidelines and leverage-driven selling fading, The crypto market has entered what analysts often describe as a cleansing phase. This is the stage where excess is removed. In every major market cycle, crypto included, there comes a point when speculation runs ahead of conviction. Positions built on short-term momentum, borrowed capital, or unrealistic expectations become vulnerable once conditions change. When prices fall and volatility rises, those positions cannot survive. They are closed, liquidated, or abandoned. That process is now well underway. Weaker hands, short-term traders, highly leveraged participants, and investors who entered without a clear risk framework are being forced out. Some exit by choice, cutting losses to preserve capital. Others exit involuntarily, pushed out by margin calls or liquidity constraints. Either way, their departure reduces the fragility of the market over time. This phase is uncomfortable, but it is not abnormal. In the United States, similar dynamics have played out repeatedly in equity markets. After the dot-com bubble burst, speculative tech stocks disappeared while stronger companies survived and eventually rebuilt. Following the 2008 financial crisis, over-leveraged players were removed, setting the stage for a more durable recovery. Crypto follows the same cycle, just faster and more visibly. What distinguishes a cleansing phase from outright collapse is behavioral change. Trading volumes begin to decline after initial spikes. Volatility remains elevated, but becomes less chaotic. Price movements slow. Participants who remain are no longer chasing upside aggressively. They are managing risk carefully. Importantly, narratives also shift. During euphoric phases, the market focuses on price targets and upside scenarios. During cleansing phases, the conversation turns to balance sheets, cash flow development, activity, and real usage. Speculation gives way to scrutiny. Projects with weak fundamentals struggle to retain attention. Those without clear utility or long-term support fade into the background. Meanwhile, assets perceived as resilient, often larger, more established networks, begin to stabilize first. For retail investors, this phase feels discouraging. Optimism has been replaced by caution. Many disengage, entirely convinced that the opportunity has passed. Historically, this withdrawal is a necessary part of resetting expectations, but a critical distinction must be made. Cleansing does not mean the market has found its bottom. It means the market is removing structural weakness. Price can still move lower, sentiment can still deteriorate, but the foundation is being prepared for a more sustainable environment. This is also when time horizons matter most. Short-term traders struggle. Long-term participants quietly reassess. Decisions become less emotional, more deliberate. And that brings us to the next question. The market must confront,
after fear, forced selling, institutional hesitation, and now cleansing, how close is the market to a true turning point? To answer that, we need to look at what extreme fear actually signals about where we are in the cycle and what it does, and does not tell us about the bottom. As fear across the crypto market reached extreme levels, a familiar question began to dominate investor thinking. Is this the bottom? Historically, the answer is more complicated than many would like. Extreme fear, such as a fear and greed index reading in the low teens, does not automatically mark a market bottom. What it does indicate is that the market has entered a decision zone, a critical phase, where the balance between further downside and stabilization begins to shift. This distinction matters. In financial history, periods of extreme fear often appear before major turning points, but not always at the precise low. Markets can remain fearful longer than participants expect.
Prices can drift, retest lows, or break lower entirely before confidence begins to recover. Crypto is no exception. During the 2018 downturn, fear readings remained depressed for months after the initial collapse. Bitcoin continued to grind lower even as sentiment stayed overwhelmingly negative. Similarly, in March 2020, fear spiked sharply before markets found footing, but only after a violent final flush. The common thread is timing. Extreme fear reflects emotional exhaustion.
rather than immediate reversal. By the time fear reaches these levels, most optimistic narratives have already been abandoned. Buyers are scarce. Sellers are tired, but not necessarily finished. The market becomes highly sensitive to marginal changes in behavior. This is why analysts refer to this phase as a decision zone rather than a bottom. In this zone, markets are no longer driven by hope, but by endurance. Participants who remain are testing their own conviction. They are asking whether they can tolerate further drawdowns or whether capital preservation demands retreat. For U.S. investors, this dynamic closely resembles equity market bottoms during major corrections. Fear peaks when headlines feel relentless, when recovery seems distant, and when participation drops sharply. Yet those moments also tend to precede periods of consolidation, not instant rebounds. Importantly, extreme fear also compresses future risk. Once selling becomes emotionally saturated, downside momentum often slows. Volatility remains elevated, but price action begins to lose its urgency. Markets pause, not because confidence has returned, but because fear has reached a point of diminishing returns. This is the moment when external signals matter most. Stabilization does not come from sentiment alone. It comes from changes in flow, reduced liquidation, slowing outflows, or quiet accumulation by longer-term holders. Without those shifts, fear can linger and prices can remain under pressure. The key takeaway is caution, not prediction. Extreme fear tells us that much of the damage has already occurred. It tells us that speculative excess has largely been removed, but it does not promise that pain is over. It only tells us that the market is approaching a point where the next move up or down will be decisive, and that decisiveness does not depend solely on price. It depends on how participants behave next, particularly retail investors whose actions during this phase often reveal whether fear is peaking or still spreading. That behavior becomes the final variable shaping the market's near-term direction. As the market entered extreme fear territory, one pattern became increasingly clear. Retail investors were selling primarily in response to emotion, not analysis. This behavior is not unique to crypto. It appears in every major market downturn, but in crypto, it unfolds faster and with greater intensity. Retail investors tend to operate with shorter time horizons and higher emotional exposure. Many entered the market during periods of optimism influenced by rising prices, social media narratives, and expectations of rapid gains. When prices fall sharply and remain under pressure, those same narratives reverse almost overnight. Fear replaces conviction. In practical terms, this shows up in how selling occurs. Instead of gradual planned exits, markets see panic-driven market orders. Investors sell into weakness often at unfavorable prices simply to stop the psychological discomfort of watching losses grow. The decision is not based on new information about technology adoption or fundamentals, but on stress. Data during recent drawdowns reflects this clearly. Wallet activity shows spikes in small balance transfers to exchanges during sharp price drops, an indicator commonly associated with retail capitulation. These are not strategic reallocations. They are emotional responses. For U.S. viewers, the parallel in traditional markets is familiar. During equity sell-offs, retail investors often sell near lows only to re-enter after prices recover. Studies of 401k behavior during market crises repeatedly show the same pattern. Fear-driven exits followed by regret. Crypto magnifies this tendency. Unlike traditional markets, crypto trades continuously. There are no closing bells, no weekend pauses, no natural breaks for reflection. When fear rises, investors can react instantly and repeatedly. This constant exposure intensifies emotional decision-making. Another factor is expectation mismatch. Many retail participants entered the market believing declines would be brief and recovery swift. When that expectation failed to materialize, disappointment turned into anxiety. The question shifted from how much more can I gain
to how much worse can this get. Once that mental shift occurs, logic gives way to self-protection. Ironically, this behavior often reinforces the very conditions investors fear. Panic selling adds to downside. Momentum deepens drawdowns and delays stabilization. What feels like a defensive move at the individual level becomes destabilizing at the market level. This does not imply retail investors are irrational. It highlights a structural disadvantage, limited access to information, shorter time horizons, and lower tolerance for volatility. Emotional selling is a human response to uncertainty, but it also marks an important phase in the cycle. Historically, markets begin to change character only after fear-driven selling exhausts itself. When those who are most sensitive to volatility have exited, remaining participants tend to be more patient, better capitalized, and less reactive. That transition sets the stage for the final question of this downturn. Once fear has peaked, leverage has been flushed, institutions have paused, and retail selling has run its course. What exactly is this market testing? The answer lies not in price targets, but in resilience. When the volatility subsides and the headlines fade, the central message of this market episode becomes clear. This is not merely a test of price levels, it is a test of psychology. Price declines are visible. Psychological strain is not, but it is far more decisive. Throughout this downturn, the crypto market has demonstrated that valuations alone do not determine outcomes. What matters just as much is how participants respond under pressure, how they process uncertainty, tolerate drawdowns, and manage expectations when narratives break down. In practical terms, this explains why markets can fall sharply even without a single catastrophic event. Confidence erodes quietly, patience thins, decisions become reactive. Once that shift occurs, price follows behavior, not the other way around. This pattern is well documented across financial history. During the 2008 financial crisis, equity markets did not collapse solely because assets were mispriced. They collapsed because trust in the system evaporated. In March 2020, markets fell, not due to earnings projections, but because investors feared liquidity itself would disappear. Crypto, despite its technological differences, follows the same human logic. What makes this episode distinctive is the absence of a defining shock. Instead, stress accumulated gradually. Each decline tested resolve. Each failed rebound tested belief. Over time, exhaustion replaced optimism. That exhaustion is the real signal. It tells us that this market phase is filtering participants by temperament rather than intelligence. Those who entered without a plan are being forced to act. Those with rigid expectations are confronting uncertainty. Those with longer horizons are being tested on patience rather than conviction. For U.S. investors, this distinction is critical. Markets do not reward the most confident forecasts. They reward adaptability. The ability to endure periods of ambiguity often matters more than the ability to predict precise outcomes. This does not mean recovery is imminent. Psychological tests do not end on a schedule. They end when behavior changes, when panic subsides, when forced actions diminish, and when participation stabilizes at lower emotional intensity. At that point, prices may still be depressed, headlines may still be negative, but the character of the market begins to shift, and that is the final takeaway. This phase is not asking investors how bullish they are, it is asking how disciplined they are, not how high they believe prices can go, but how much uncertainty they can withstand without abandoning structure. What comes next will depend not on hope, but on resilience.